We now start our fourth session, and it's very heartening to see that actually post-lunch the hall is absolutely nicely full. So thank you all for being with us through the day, and I think we are due for the next session. The changeover, please. So as we do the changeover on the stage, a little bit about this session now, which we are going to start. The working capital and payments are two very major issues for the MSMEs to enhance their business. Hence, the Bengal Chamber has been connecting manufacturers to fintech so that this issue may be addressed. This current session, which we are about to begin, has been designed on how the fintech platforms may be leveraged. So the session will be chaired by an expert of this particular field, and then we will have, of course, the panelists. I think, you must excuse a little bit of a little lethargy, I think, from everyone post-lunch. So we're just getting it started. As we have the session, please do have your questions ready, because soon as the session, the panelist completes, the chair will surely ask for questions. So do have it ready so that we can quickly go to the next session with the time is being very tight. Okay? Right. So this session is going to be chaired by Mr. P.K. Wilson Putti, Chief of Marketing, Tata Steel, who has been working on this for quite a long time. Mr. Putti, may I please invite you to come to the stage and to chair the session. The panelists, may I invite Mr. Rishabh Agarwal, Senior VP Credlix, right? Have I pronounced it correctly? Thank you. Mr. Vivek Chauhan, Chief Commercial Officer, L&T Sufin. Mr. Amit Sachdeva, COO, MI Exchange. So our panel is full. And Mr. Putti, the session, please take charge. Thank you.
Thank you. So good afternoon, everyone. We had an excellent session on the bankers speaking what they have in store for the MSME segment. One of the most important thing we heard was finance. And with me are the fintech companies. And as I was speaking to them, I was wondering whether they are finance companies or technology companies. But for sure, they are innovators in the space. They found a space where value can be created for all stakeholders. And there is a lot of disruption that they have done. And I think it's just the tip of the iceberg. So before we start our discussion, a little bit about myself and my business. It is more to do with the context where my business has ended and where I thought I needed bankers, then I thought I needed fintech companies, then I thought I needed technology companies, and I am a confused person. So this is the right place to actually figure out where to go. And somebody asked a question also, how to decide which bank should I choose. I'm still deciding which category should I choose. So I head the steel marketing, branded steel marketing business, roughly around from Tata Steel, we are servicing almost 4.5 million ton steel to the MSME sector. We service more than 10,000 MSME customers directly through our channel partners, and almost 15,000 dealers, again through a separate set of channel partners. Many of them are common. And going forward in our journey, it's been a 15-year journey, and we find that if we need to grow, yes, credit is one of the, or the finance is, access to finance is one of the very important levers for growth. It's been one of the levers for growth for us, for our channel partners, as well as for our MSME customers. To that extent, we started a program called Urja. Urja program is a platform on which, on one side, we have the MSMEs who come in, and the other side, we have the banks which are there on the platform. Apart from the banks, as we started this program, to move this program fast, we brought in some NBFCs also. And right now, we want to move this program even faster. The reason being, the demand for money is very, very high. And if Tata Steel needs to grow, today we are 20 million ton. If you were there since the beginning, you heard one of the speakers saying Tata Steel wants to become a 40 million ton company. And today we are 4.5 million tons in 20 million ton. And the next 20 million ton, may 60% of the growth will be catered to the MSMEs. And that is a kind of, and it is, when I'm talking about Tata Steel, similar is and will be the story for JSW, for AMNS, and for SAIL also. So the kind of potential that finance and the role that finance will have going forward. So we kept speaking last 5-7 years, if you see, that MSME is the engine for growth. I think this is the oil and different kinds of oil that we have been talking about post lunch. So I would start with, uh, since there are with me Vivek Chauhan from L&T Sufin, Amit is from M1 Exchange, Rishabh is from, I would still use the word Moglix if it is okay. Yeah. So on a larger umbrella, Rishabh is from Moglix. So my understanding of fintechs was, fintech is all the same, one and the same. I knew bank is a different, NBFC is different, and fintech is the third. But when I started interacting, each of them have a different segment, a business segment, and that is how it is all emerging. And I think it is a good way to start this discussion, to unpack as to what is each of your business models, what is your offering, what is your value proposition, and how you are different in terms of segment, and some overlaps maybe along with you, because each of you, I think three of you, know each other's business also a little bit. So I would like you to share with the audience, starting with Vivek.
Thank you, Wilson. I'll quickly tell you that I'm neither a fintech company, neither a technology company. We are essentially, L&T Sufin is a marketplace. So we don't sell or buy anything. We are just a marketplace. It's like a mall where we provide stores to many sellers, and we bring buyers onto the platform. I think, I'm the youngest of all the people on the dais in terms of the age of the company. We just completed 1 year a few days back. So L&T Sufin is what the target segment which we cater is essentially SMEs. So all the transaction which happens from SME to SME, or SME to a large corporate, very rarely large corporate to an SME. So essentially these are the target segment. So what do we do? So we have a platform where we have onboarded in the 1 year 40,000 suppliers, sellers, which are into all kinds of B2B application. So it can start from raw material, MRO items, and many other things. So essentially all the things, lightings, fittings, etc., all the categories. But essentially in the last 1 year, there are 3-4 categories which we have seen has got a larger traction. And there we are doing well. The important point which we realized very soon is that India is a country which is deprived of finance. There is a liquidity crunch, although we have many bankers, but getting working capital, loans, etc., it's very difficult. Although in the previous sessions, there were discussions which happened on how bankers are coming up with products for the SMEs, but it is actually what our experience has been, it is very, very difficult. So what we do is that we curate, we work with banks, mostly NBFCs, and many other forms of lenders on the platform, curate products for a specific segment. When I say curate, we structure the kind of payments, so the structuring of the lending, we do it, and then we offer it for making sure that people transact on the platform. Our business model is very simple. We transact, we take a cut or commission out of it. So it is important for us that transaction happens. And what we often seen is that finance helps the conversion faster, and it also increases stickiness. So what I am looking forward to is that how in my business, how this financing programs, products evolve, which currently right now is limited to few types of lending options. So that's all from my side, Wilson.
Thanks, Vivek. So moving to Amit, if you can share your business model and offering.
Sure, Wilson. So if Vivek is 1 year old, he's a kid on the block. We thought we are the kids on the block vis-a-vis the Kotak banks and Yes Bank and SBIs. But yes, in fintech ecosystem, we are a veteran. We are 6 years old. That's a long time in fintech world. This is before the GST started, before Demon started. So if I were to put in a nutshell what we do, we are an exchange for MSMEs, all MSMEs to get their receivables faster. So let me dwell on the key parts. One is exchange. Just like there is an exchange called National Stock Exchange, there is a BSE where you can trade in stocks. We enable MSMEs to trade on their receivables. So if you have receivable from a company, a large company or a government, you can come to the exchange and you can get your money today rather than waiting for 45 days time or 90 days time as a case may be. And you have a choice of 50 plus banks and now NBFCs as well. RBI has been kind enough to finally allow NBFCs. So we are an exchange. And the second part is we allow you to trade on your invoices, get the money now. We have been live for last 6 years. We are one of the 3 RBI licensed exchanges to enable this business. We have about 16,000 MSMEs who work with almost 1,100 large companies and PSUs and governments to ensure that we can provide them almost 3,000 crore of funding every month, which is almost 36,000 crore of funding every year. So far in our journey, we have enabled almost 45,000 crore of discounting last 6 years since we have been live. That's what we do. Wilson said, a very nice question. Are we fintechs? Are we technology companies? Are we finance companies? I guess one problem that most bankers would have faced is the lack of that flexibility for the business and technology to come together and solve a problem, a real problem. I started my career in 02 and every year I was sharing with Wilson some time back. Every year since then, I would go to some SME forums and workshops, and this problem of credit gap of MSME would always come up. Each stakeholder, the regulator, the government, and the banks would think of this as a big opportunity, a problem, but how to solve has always been a problem. It used to be $100 billion gap way back in 02. Every 3 years, it kept increasing from 100 to 200, and in 15, when I started my journey to solve the problem, it was a $500 billion problem. Now it's grown to a $800 billion problem. So every year the problem is increasing. But what the right answer was, is always a question. I think finally the right combination of fintechs working with banks is coming to be the right problem, right solution. And the way I look at the whole problem solution has four elements. One is getting the customers in. Customer acquisition is a big problem for most models. It's not just financing, but you look at any industry, be it auto industry, be it you as an MSMEs, the customer acquisition is a problem. So who does that is a big problem to be solved. But MSME financing is not the problem of customer acquisition. It is a bigger problem of underwriting. It is a problem of you figuring out who is the good customer to be lent and who is not. So it is the risk management problem, and hence a very high focus has to go into figuring out how do you figure out, is it on a cash flow based lending, which is what I think we heard in the previous panel very appropriately. Is it on the balance sheet? But that's a key question, and that's something which most fintechs are working towards, including us.
Okay. So Amit, we will come back to you on how do you assess risk. But before that, Rishabh, if you can explain your business model. And what I understand is, like we heard from Amit, the demand is continuously growing in terms of the need for finance from the MSMEs. The gap is increasing, is what he mentioned. What he heard 15 years back and what he is hearing now, that it's only increasing. So the demand is increasing, and hence the gap is also increasing. But I see that your company has also gone into the export market also, if I am not wrong. So apart from a business model, if you can also share how that particular aspect is helping, and especially connected to MSMEs.
Sure. Thank you, Mr. Wilson. Good evening, ladies and gentlemen. Thank you, BCC&I, organizing this event and giving us an opportunity to talk about the issues at hand, especially on the working capital side of MSMEs. Now, since I was introduced as somebody from Moglix, a bit about Moglix. We are Asia's largest B2B commerce company. We would supply the MRO supplies to more than 600 large corporates. We end up procuring these from about 20,000 SMEs. We have warehouses in more than 45 locations across India. Essentially, in a nutshell, we would digitize the procurement function for a large enterprise. So, and the reason I wanted to give this as a background is I lead the Credlix, which is the brand name of supply chain financing arm of Moglix. Now, as you would have understood that, we are a specialist on managing the supply chain for large manufacturing clients. And the same has been reiterated since morning that, the working capital is tough to arrange, is difficult to get, lot of questions. So, as a fintech, we are looking to solve the 1.7 trillion working capital gap that MSMEs have globally. So I'm just putting a new number higher than my co-panelist gave, but then this is a global number, and this is the quantum of the problem that MSMEs have in terms of working capital gap. About the solutions, a couple of quarters back we celebrated India's exports reaching a landmark of $400 billion. Half of India's exports is contributed by the MSMEs, which is where Credlix would come as a factoring solution company. For SME and MSME exporters out of India, we provide no collateral, no recourse factoring. Essentially, you get your money the day you get your bill of lading with no recourse. The buyer bankruptcy is not something that you need to worry about. And the same facility can be started in 3 days flat. So that's on the export side. On the domestic side, our financing facilities start right from the purchase order level. So while we can, the moment the purchase order happens, there is a need for working capital to procure raw materials, which is where our purchase order financing solutions come in handy to the entrepreneur who can use this facility to procure raw materials and focus on their core business. Other than that, we also have a vendor financing arrangement. It could be anchor led, which is where a large corporate would sign up for a program for all for the early payment of their vendors. We have vendor led invoice discounting, which is without the anchor getting involved. We also have on the sales side the channel financing program, and I think since morning we've had several discussions around the issues that we face. So as a fintech, we are solving the channel financing issues at hand, especially at the dealer and the distributor. So essentially, the banks have been able to penetrate onto the tier one dealer, or rather the distributor leg of it. As a fintech, we specialize in solving for the long tail.
Okay. So both Rishabh and Amit, we heard that you have solutions both for vendor finance as well as the channel finance, customer finance. So what percentage of your business is on the vendor finance side and versus the channel finance side? Is that difference something to do with the risk assessment? Because per se what we heard is from the banks to the NBFCs to now the fintechs, the level of risk, the risk appetite grows, and maybe you found some way how to de-risk that or understand the risk and de-risk that, if I may call it. So can you just share between the two kinds of businesses how you are kind of slotted, and what is driving that?
So essentially, what we are doing is we are funding a transaction. What we do is, as the previous panel said, the end purpose being defined is very important, and that's a core to our entire business model. We fund a transaction between a buyer and seller, and unless that is not known, we don't fund it. Now, what you're funding is multiple use cases. There could be a use case of a dealer selling to a large corporate. Let's say there is a slide, L&T is doing a project at a site, and there the diesel has to be bought. The dealer will supply the cement or diesel. Another use case which would typically be could be in a way funding the dealer. Just that rather than funding the dealer when he's purchasing the cement or purchasing the diesel, you're funding the leg when he's selling that to a large corporate like L&T. There could be another use case, which is where you have a auto component supplier selling to an OEM, right? Or an equipment supplier selling to Tata Steel. So there are multiple use cases, and hence to be able to exactly figure out how much is dealer financing and how much a vendor. It's a slightly tricky part. But if your question, Wilson, is how much of this is on the sales side and how much is of that is on the procurement side, yes, today I think about 9% to 10% would be on the sales side, and remaining is more on the vendor side.
Okay, I'll come back to you. Rishabh, what would be your, in terms of between the sales side and the procurement side?
Well, 80% of our current business is on the procurement side. As I said, we're solving for the anchor-led and and the vendor-led invoice discounting. So 80% is there. On the dealer side, we've made inroads. There is one very decent use case that I would want to see. So a large mobile manufacturer would want to really finance their long tail, which is essentially the dealers. Now we are all used to buying mobile phones from the e-commerce platform, but still there is an offline market. People reach out to these dealers and looking at taking the mobile phone at your hand, you end up buying a phone from there. So purchases of their inventory, we would set up a limit for every dealer basis the limit thrown by our AI and ML model that we run on these dealers. along with the data which is provided by the mobile phone manufacturer. And the dealer can use this limit to buy inventory from the distributor, and that's how your sales realization runs faster.
So Vivek, we heard that from the fintech side, the industry is like roughly 80% on the procurement side, 20% on the sales side. And you mentioned that finance is something which accelerates the transaction in your platform. So my question to you is, with this kind of structure of how the industry is evolving and in the marketplace, when this finance is required, two questions. One is, how is the access to finance, how is it improved? And in terms of from a risk perspective, how is it distributed between the players in the marketplace?
Yeah, so I have experience of 1 year only on dealing with the NBFCs and the banks. See, what I certainly will tell you that the lenders are becoming much more forthcoming in serving the SMEs, as Amit was also mentioning about. He was alluding to the fact that a vendor SME supplies to a large corporate, it becomes much easier for the banks to discount the invoice. But the transaction becomes really risky for any lenders when they're doing an SME to SME transaction. I doubt a lot of percentage would be discounting SME to SME, or the rate will be extremely high. But what I feel, and what I have with some of the NBFCs we are doing, we don't have an NBFC. So the platform, on the platform there are certain NBFCs, they're using our vintage of the last 1 year, and they're trying to use those some algorithm the fintechs are using and the NBFCs are using to make sure that how the SME thing can be worked out. So with one of them we have cracked it. So what is happening? Two things have happened. The limits, which essentially used to be around 10 to 15 lakhs for those guys, have gone up to 35 lakhs. And the program size they have increased based on the vintage which we have been providing in terms of. So for example, a guy in 1 year, the number of transactions which an SME has done, a good guy, will be around close to 35. So 3 to 4 times in a month. So with those data, they have increased the program size, and that's how. And on the point which you were mentioning from the seller and buyer, it is what I have understood, the lenders prefer giving it to a seller than to a buyer, because they know why they are taking the money, the material is visible. But from a buyer's perspective, it is difficult to, what is he doing with the money? But that aspect also needs to be cracked. So currently our percentage, what I have seen is that significantly higher for a seller funding than for a buyer funding. That is what we have seen in our platform.
So a healthy development in terms of, I think the limit size is increasing and the program size increasing. So something good has surely happened in the fintech industry in terms of from assessing the risk, mitigating the risk, or share with us slightly in more detail in the subject of how do you do risk assessment, because increasingly, and Rishabh also mentioned that you are getting into the tail. So what is your first hand assessment of, in a space where you have gone? All of us, because it's a black box, so we think that it's a risk, because in the previous session we actually heard the bankers saying that the portfolio of MSMEs is actually much better. I think that is what we heard from both of you. So when you are venturing out in a large scale in this particular territory, it was the risks are higher, or it is not, or if it is higher, then how are you managing? Slightly in detail, so let your magic come out.
So I think what we heard in the previous panel is what we as a platform are experiencing as well. The whole focus and comfort of the banking community on MSME lending and uncollateralized lending is getting much better now. multiple reasons for that. But the way I look at it, this is maybe post-COVID is like the fintech wave 2 or MSME lending wave 2. A lot of experimentation on uncollateralized lending, cash flow based lending, transaction based lending to MSMEs had been on. They were small experiments. I think the fintechs and the banks were collaborating to figure out what model will work or not, but they're small pilots. I'm sure the Yes Bank has been doing multiple pilots on GST based lending. Kotak Bank has been doing those pilots, but they were small. I guess what has happened over the last few years between wave 1, wave 2, and wave 1 was between maybe 2014 to 2020, is a lot more data is now available, which was earlier not the case. GST started in 17 and people are still trying to figure out, is that data real, recent, are all guys reporting or not reporting? The access to GST was a problem. Now what's happening is GST is a lot more formal channel, 1.5 crore GST registered entities. That's a lot of entities. Easy to access data because you could, with the OTP, you could get GST data for last 2 years. Bank statements are now a lot more easily available. Account aggregators have come in. Earlier asking an MSME to download 24 bank statements for last 24 months because some banks were giving bank statements for a month, which means if I had to ask an MSME to give me access to his last 2 years of banking data would mean the poor MSME who has to run multiple things in his business to download 24 bank statements and upload it on the platform. A lot of task. Now with account aggregator coming in, almost 18 banks on account aggregator, it is one OTP. So the process has become a lot more less friction than it used to be earlier. Can get better, definitely, but gotten better. So a lot of data is becoming available, which was not the case earlier. Bureau. The commercial bureau used to be very, very shallow till 3-4 years back, has gotten a lot more richer. Otherwise, to get access to the real repayment track record of an MSME, one had to go to the individual bureaus. And if there were 5 directors, which means looking at the 5 directors' bureaus. And someone spoke about in the previous panel that an independent director coming in, now because this MSME who has not paid on time would reflect on the individual director's bureau as well, which would impact his ability to borrow. So now with commercial bureau coming in, that data is a lot more richer. So just a core element of data being more richer, easily available is one part which has changed a lot. The second thing is most banks in a way have realized that the large ticket corporate lending has its own pitfalls. Very high concentration. One company goes down and suddenly you have a lumpy NPA sitting. And to compensate, now you have to have a lot of base or denominator of clean book coming in, so that percentage looks better, right? Suddenly when the NPAs shot up from less than 1 percentage point to more than 3%, 4% 5 years back, it shook the whole banking community, and they realized the importance of a granular book. So the focus on retail, focus on MSME, retail has become a lot more competitive. Every bank has been able to find models to give loans to salaried people, but SME is the is the middle piece, which is neither in the corporate side nor the retail side, and that's a very attractive opportunity. So a lot of banks are getting attracted towards MSME. It's the other part. So I've not seen that openness on unsecured MSME lending for last 7 years. I've been trying to solve the problem of MSME. So that's a very, very welcome change. I think third part, and not to discount that, is the whole focus of the government. India as a country, the amount of focus we are showing on MSME, and all of us knew that MSME sector contributes some 40% to exports, to employment, 30% GDP. It's been talked about in each workshop I've been to last 18 years or 20 years time now. But this government has finally shown the focus of bringing changes which are required for the MSMEs to get uncollateralized debt. The CGT MSMEs has been there, but it has its own pitfalls. Now CGFSF is coming in, which will allow banks, NBFCs and platforms to benefit from the fund for factoring. The factoring as a product being made a lot more beautiful than it was earlier. So multiple things happening from the regulatory government ecosystem to ensure that this can happen. And this is showing up in the whole partnership between banks and fintechs, which is important. So that's one part why there is so much of fondness, so much of liking for unsecured MSME credit. And as I said, the key to solving the problem, it's a big animal. 1.7 trillion is what the co-panelist said. Indian number I knew of was $800 billion. The key is digital underwriting, digital risk assessment, and for which multiple experiments have to happen. I don't think anyone has the answer right now. We've been trying multiple experiments. It will take maybe another 5-10 years for us to get enough data to get to a scientific AI data based or data science based modeling to predict who's a good borrower, who's not a good borrower. Right now there are enough pilots, experimentation which are underway. But hopefully be on the right track. And for this pilots to happen, there has to be a mix of technology element to come in. There has to be the right blend between the experts of underwriting, risk management to come in, to sit together, brainstorm, and figure out how to tweak the models each day, each passing day. And now that experimentation is where I believe fintechs come in, because they are more nimble, more flexible, they have in-house technology teams, and hence this tweaking and learning can happen faster. There'll be failures, there'll be success. Both ways there'll be more learning to figure out what to do and what to scale up. And that's where fintechs come in. The banks come in with very, very low cost of funds. They come in with their compliance regulatory structures, which ensure that whatever is done in a very, very system which is predicated on high corporate governance. The two coming together is the answer. And I think this is where how it is going to take shape for next 5 years.
Okay. So, Rishabh, something on your risk assessment model?
Yeah, before that, just want to, bring in one more stat. The penetration of factoring in India is abysmally low. And just to put this into perspective, factoring as a percentage on GDP in Europe is 9.6%. In US, it is around 6%. In China, it is about 5.75, and in India, it is 0.5%. So this is the kind of headroom that we have, and I guess there's place for everyone. I mean, right from a bank to an NBFC to a fintech to any other model that might evolve tomorrow or day after. So that's something coming on to the underwriting part. I think my co-panelist Amit has actually taken us through in a very detailed manner. What additionally I would want to say where fintechs have an advantage is that traditionally banks have been looking at, and let's say if we are looking at financing the long tail on the distribution side. So banks traditionally have run a very physical model that, okay, I'll have a hub and spoke. My hub would have an office in Pune. It would run to all Pimpri, Chinchwad, and all the peripheries of Pune. Somebody would physically go, click a picture, do a physical verification of the guy, and then somebody would approve it, and then we may choose to finance this guy or give a line of credit. Fintech, once the data is confirmed that, okay, this person is a dealer or a distributor by the company, can do this onboarding just by downloading an app. Our algorithm would decide whether this person deserves a line of credit, yes or no, and then beyond that, what is the line of credit that this person might require, and do the KYC, do the penny drop to complete your onboarding, and you are ready to go. So I think that is the kind of solution which is very non-physical, and it's available 24/7. That's what would differentiate a fintech solution.
Okay, so we understood the difference between how the bank operates and how the fintechs are operating. But even within the fintech space, is there a different way of credit rating for, say, a micro customer versus a small customer versus a medium customer, and also a Indian customer versus a overseas customer? How how are you guys doing that rating?
Yeah, I think maybe I'll go first. Yeah. So uh, it's funny because the devil is in the detail, and when we say that there's a lot of data which is available on banking, on GST, on the credit bureaus, it's all about how you deal with this data and what you do with this data. Uh, there are a lot of granular problems which have to be thought about. The answers have to be thought about, and that's where the innovation lies. So, for example, if you have a bank statement of an MSME and you have 1,000 lines, now what you do with these 1,000 lines is the big problem. And I think previous panel talked about getting the answers, how a physical underwriter will look at that bank statement, but getting it digitally. That's the key. Now you have to figure out as an underwriter on how healthy is the business, which means the first thing you have to figure out is the revenue of this business growing or not growing? Now in financials, you could get just a one figure for the whole year. The bank statement can give you that number for each day, for each week, for each month, which means you will have maybe 52 data points to look at his weekly revenue, and you will see whether his revenue is going up or going down. Uh, some of the 1,000 data points or lines may be about his vendor payments. So you figure out whether his entire trend of vendor payments is increasing or stagnating or decreasing, and is it that line with the whole revenue trend or not. To figure out if you've actually been able to get all his bank statements and all the information. If he has taken any loan recently which has not appeared in his CIBIL, because CIBIL starts reporting with a lag, but it is existing in his bank statement. So can you triangulate the two sources so that you have complete understanding of his entire obligations or loans? So that's where these are the small problem that have been solved with the use of technology, automation, so that you have a much better understanding of his MSME's business than it is possible manually, because nobody can look at 1,000 data points in a few minutes time as a person. It is impossible. This is where tech comes in. This is where automation comes in. So every organization, every fintech has to find answers on its own on how to get answers to these problems. And this is where the real value lies, the rich insights coming from that data. Now, whether you look at and the way you look at an Indian business versus you look who's selling in domestic market versus looking at somebody who's selling in export market and getting money in euros and Japanese yens and dollars, and how much of that is coming here versus, for example, figuring out if I'm getting money in foreign currency, but which geography is the buyer in? For example, if the buyer is sitting in Pakistan, he's only one buyer, or China, then you are selling or your business has a high concentration in a geography which is politically very sensitive. So maybe not a great business. Now, how do you build these insights into your algo, into model, will define the success or not a very successful model.
I'll take the overseas buyer underwriting part first. So when we do factoring, and a typical MSME exporter has exported goods to, let's say, a developed geography and a not so developed geography. Developed would be Southeast Asia, Europe, UK, US, and Canada, of course, where we have a very developed rating mechanism, and which is almost like a real time estimate of their financial strength, their payments, and which is what we would rely upon, because in a typical factoring transaction, we would end up releasing 90% of the invoice immediately to the exporter in question, and this is without recourse. We don't ask for collaterals, so naturally the underwriting of the buyer is a must. So a lot of data is available, and the ratings is such a robust mechanism in especially in the developed geography, that at times when the payments are delayed by the buyer in question, even a rating agency's a call or an email would just push them into making those payments, unless there is a bankruptcy issue. So that is something which helps us bring up a totally unsecured non-recourse kind of a product. In India, the underwriting mechanism with lot of data available, not just traditional data on the financials or the GST data or the banking data. uh, you know lot of companies would enable us to get the transaction data. We could see the buyer and supplier, and establish the vintage of the relationship, the kind of payments that have been made, the kind of returns this supplier would have seen. So basically, what when an invoice was raised, and what was the net that was paid. So all these factors, when you put it into a system, and which gives weightage to each of these financial behavioral things, and then it throws up an eligibility that, okay, you want to go ahead with financing, uh, or you would want to hold on. So
Oh, thanks. So essentially, you are in a position to take a higher risk on the export customer because of the way that they are structured in their industry, in the ecosystem, with respect to information transparency, etc. Vivek, very quickly, in your platform or the marketplace, how does the working capital of the customer gets managed? Is there, or through invoice discounting, etc.? How do you take care of that?
So I understand the risk part of it you are talking about. So what we do is that since nothing is on our books, it is on the lenders, either it on the lender's book, the borrowers, or the person is either a borrower or a lender. And so what we do, we have developed in the last 3 months, what we have done is that we have developed a credit management. We have developed a division, a department, which is a credit management group, which actually sees the data, how, at what time some of the payments are going, not going, etc. These are essentially data which my fellow colleagues were mentioning about. We have started tracking them. We are sharing it with the lenders. The lenders also are giving some information about it, that this customer, we forgot that the buyer and the seller are somewhat linked. Okay, so either they are family members, long distance family members. So these are some of the red flags which should not have missed. But what we do is that we try to the credit management policies we have developed, we share it with the banks, and the banks also lenders also share it with us. So essentially what we are trying to do is that we are co-opting to make sure the program is alive, because we know if one delinquency happens or few delinquency happen, this program will be shut. And that we have to be very careful about making sure that those people are still interested in funding the transaction which is happening. This brings me to another point, is that what has another issue which is there is that for a bank, not the NBFCs or the fintech, for a bank making a program for, say, a platform like us, or probably a few years back Moglix would have also faced the same problem, that their program size is so small in comparison to the actual books they handle. The interest on those programs are very low. So when the interest on that program is low, their due diligence is also compromised sometimes. So we sometimes feel so that is more important. Then it makes more important for us to make sure that the due diligence happens properly, especially with these banks, and the program is not jeopardized. Yeah.
Thanks. So one last question, which I would request each of you to answer, is in terms we heard about banks, NBFCs, now fintechs, and you are talking about a lot of experimentation and pilots going on, and because the space is so big and evolving, and the need gap is large enough. So going forward in future, how will banks and fintechs work together collaboratively, in which spaces? Where will fintechs venture on their own? Or is there a third model which will emerge going forward? Just your views, each one of you.
See, what I feel is that sometime the banks are going to go fintech way. Some of the fintech may change and may move into getting banking license. You mentioned about they taking factoring license now in India. So factoring. So a lot of people will do a lot of things. I also feel that a lot of platform will come up with NBFCs of their own and funding their own set of customers, which probably Moglix has come off business as a similar one. So it is going to be a mixed bag where the traditional lenders will move into all the space, be it NBFCs, factorings, and the other stuff which was mentioned. And I also feel that new lenders specific to a certain platforms will emerge for their own customers.
Thanks, Veer.
So to answer this question, let me look at some of the successful models which are working on between fintechs and banks. And there was a time when the fintech revolution started in India, and some fintechs used to be very aspirational to say that, listen, we'll kill the banks. And I think those were early days. People were still trying to figure out what will work, what will not. And I think it is very kiddish to believe that the fintechs can actually kill a large institution like a bank, which have been here for decades now. I think that would never be the right answer. The answer is let's figure out what is a problem statement that a fintech can solve for, and whether it can solve that in partnership or in competition with the banks. That's the way to look at it. If I look at the different capabilities required to solve the MSME problem, there are 4 aspects to ensure that the liquidity is available and available at the lowest cost. Number 1, first there has to be liquidity. There has to be somebody with the money. Fintechs usually will not have the money. There will be startups, right? So you have no choice but to work with an institution like a bank who has the capital, number 1. Number 2, there are 4 essential costs in the whole lending problem. One is cost of acquiring the customers. And who has the best capability to acquire a customer? A bank with X thousand branches. Will the fintech with its pure digital reach, spending on Facebooks, spending on LinkedIn, spending on Google's be able to compete with that cost? Unlikely. So they are well placed to look at the whole cost of customer acquisition. Number 2 is the cost of funding. The cost of funding, a startup will never be able to match that cost of funding with CASA of 40%, 50% sitting with a bank. Number 2. Number 3 is the whole cost of underwriting or the cost of operations, managing the whole backend. Once the application comes in, then how do I manage the whole backend? Which is where there's a huge element of technology, automation, digitization, or what in banking system is called no ops. That's a dream state of no ops, which cannot be achieved unless there's a huge amount of tech driving that. Which is where I believe today banks are not able to get to that level of perfection because they don't have the in-house technology element. The dependence on the vendors has a limitation because the speed is lower, which means you cannot before you can get to the next version, you have to wait for 2 years. For the RFPs to come in, for the whole BRDs to be completed, development is to be completed, adoption, it takes 2 years time. The fintechs can crunch the time frame from 2 years to a month, and that's where they can learn much faster. So this is where I believe the cost of underwriting, cost of operations can be much lesser if fintechs play that role, banks play the role of customer acquisition, and the cost of capital and the cost of compliances. If you put the two together, is where you have the lowest cost of lending for SMEs, and this is what we're finding in our model. So as trades, today we discussed about the whole factoring being less than 0.5% of GDP. The number is $9 billion. And out of $9 billion, almost 30% of that book is coming from trades. Factoring as a product was a dead product in India till 6 years back. Till the point trades came in and they said, listen, it's a beautiful product. The problem is it has been implemented, it has been executed with a very, very physical layer where you cannot have an audit trail of whether the buyer has accepted that assignment done by the seller or not. So let's bring in technology, let's bring in a complete transparency and audit trail of the whole transaction being assigned, which is the underlying model of factoring, and being accepted by the buyer. So buyer tomorrow cannot say, I never accepted the transaction. Now that is growing at almost 100% year on year. And this is happening in partnership with more than 50 banks. Almost 20,000 crore of outstanding in partnership with 50 banks, which is now working well. That's the largest fintech model operating in the country very successfully. The role of trades today lies more in managing the whole transaction. By the way, while my hypothesis was that the customer acquisition would be best done by the banks, but today the trades are doing the whole customer acquisition as well. The large corporate customers, SME customers, and it is enabling a bank down south to look at a customer up north, which would never have been the case for a bank like a KVB or a City Union Bank to fund a Jindal who is a north-based corporate or a MSME based in Gurgaon. Would not happen. Vice versa, taking a bank which is there in north, a PNB, and letting them get to a customer down south is not today possible because of this partnership. So to me, this is the core to success. Hopefully these models will scale up and multiply going forward.
Thanks, Amit. Rishabh, last.
Well, to answer this question, I don't think so. It's whether it's a bank, PSU one, or a private one, or an NBFC or a fintech. I don't think so. It's a winner take it all kind of a market. The problem which is being solved traditionally by PSU banks for more than 50 years or so has increased. Then came the private banks, has still increased, and NBFCs are also trying to solve it, and now fintechs are solving it. I think the answer to the question here is that is the combined strength of all of us will take, because the goal here is to solve for the working capital situation for the MSMEs. The goal here is not to compete and say that, okay, I am the best or my model is the best. So collaboration, that's the key that I think. The collaboration has already started. Banks are unlike 5 or 7 years back when it was like Amit pointed out, it was fintechs thinking that we will overtake the banks and the bank taking fintechs as a competitor. I think there's a lot of collaboration now. There is importance that the role that each one plays and the kind of value add that one brings on the table is respected by both partners. Amit has detailed it in terms of capital, in terms of customer acquisition, which is where the banks say, and in terms of technology, getting the platform, all those tech capabilities, which is where the fintechs can bring in. So the only thing which is is a request to the regulatory aspect of this entire financing ecosystem is to just enable the partnerships in a manner where these can flourish at a rate which is 10x higher than what it is going currently. So I'm just referring to, 6 months back, there were certain ways the fintechs and banks were partnering in a certain manner. Then regulatory action happened, and now everybody is looking for a new model of how to partner that. So I think that's a play that I think that the regulator in India, which is the RBI, has to play, is to bless us with one partnership model which they think is good, and then let's put all our combined strengths together to solve this problem.
Okay, thanks, Rishabh. So that is one point we can take as BCCI to the PMO's office in terms of how this need for finance, which is the gap which is ever growing, and how can we build partnerships with banks, NBFCs, fintechs, etc. So I think that is surely a subject which will be taken up. So thank you very much for very useful insights. I think the audience would have loved it. Do we have time for questions, or there are so many hands that I would request you to allow at least one lucky question.
Hello. Yeah, so my question is pertaining to where we were discussing about risk and all. And one of the points you touched upon is the buyer and seller dependency. So in your entire risk analysis, if I have to say, suppose, what will be the weightage you give to a data that how much a buyer and a seller is dependent? Because I want to know that the independent GST and all those analysis which you do, what level or degree of credibility that gives about the customer vis-a-vis a buyer and seller data which has existed in a platform or a portal which you can leverage. So that is my question to the team.
As always in life, there are no black and white answers. There are always shades of gray. And again, depends on that specific case. But let's say if you're looking at one seller selling only to Tata Steel. Tata Steel is a fantastic company with decades and centuries of vintage, and that's absolutely fantastic. I think the model will love it. But if, let's say, there is, as I said, only one customer that this seller is selling to, and that seller buyer happens to be sitting in Pakistan or China, which is geopolitically very sensitive, it's bad news, right? So higher concentration is usually not good, not preferred, because something which goes wrong with one customer can completely rock the model. So most models will prefer lower concentration, both on supply side and buyer side. However, as I said, there are cases where if you have a really solid buyer, for example, Tatas, I think the models will still love it.
No, my point is, suppose you have a 10 crore of budget and I have asked that I want to fully utilize it. You will run a model. So what percentage of it will you be able to cover through independent, say, digital document upload, vis-a-vis if any firm, be it Tata or any platform who has aggregated the data for so long, this buyer is dependent on this seller for these many years in this frequency, will help you aid to that. So what degree of risk will you take vis-a-vis what degree of risk you will take once this data is provided? Just not a gray or a kind of what is the norm which you do? That is what I want to understand.
So maybe I can give the platform answer, and there are financiers who operate in the platform as a financiers. They have their own set of constraints. So most financiers who operate on the platform for our unsecured, uncollateralized risk on an MSME, usually with the whole underwriting being done on GST and banking, they would go up to 1 to 2 crore of limit sanctioning, and with the data coming in from an anchor as well, with enough vintage, etc., that could go to maybe 5-10 crores as well. So
that is the third model which we can talk about, that not only NBFC and fintech,
right,
maybe the anchors, data analytics and tech team will be also critical in this entire project. So just that was the point I wanted.
Very valuable. Yes.
One last question, yes.
So this is for Mr. Sachdeva, that you have told about that KVB Bank of South taking over the clients in North, as well as the Bank of Punjab National Bank taking over the clients of the South by way of trades. So can you please elaborate how it's trades? Little that, because we are in a physical distribution, probably this could be of help to us.
Yeah, sure. So the whole TREDS stands for Trade Receivable Electronic Discounting System. The model is as mandated by the Reserve Bank, which regulates us. We have been mandated to enable the MSME suppliers of any company, could be a PSU, could be a private company, to get their invoices discounted on the platform, which is subject to the buyer. Buyer, as said, could be a private corporate, could be a government institution, could be a government body, confirming that this is a genuine invoice on the platform digitally. No email, no physical work involved, just that they do a tick mark that this is a genuine transaction. Subject to that happening, there are some 52 odd financiers now on the platform. They compete for each invoice. All the interested banks would just have to come and bid, just like you would come and bid for buying a stock on NSE. You come and bid for buying that invoice and discounting that invoice. So there could be, for example, 20 banks, and they would show interest. It's up to the MSME or the buying corporate to accept any specific bid. More often than not, you will accept the lowest bid. So now KVB, without having to worry about where exactly is the seller or buyer, could be sitting in Kochi, for example, in their head office, could bid on this.
Okay. One addition to the last point, I'm very much aware about your platform, and M1 Exchange is mainly doing for discounting for a company turnover below 500 crores. And whenever we approach your organization, it has been told that if it is a more than 500 crore organization, it will be treated as a M2 exchange. So the rate of discounting in M1 and M2 is different. And now the companies who are dealing into such high value added commodities, this kind of turnover crosses very fast. So
Right.
how can it be that the same rate of discounting is applicable to both kind of company on your platform?
Sure. So on M1 exchange, the only constraint from RBI is the seller has to be an MSME, which means you have to have the Udyam Aadhaar. Now, as per that definition, the turnover ideally should be less than 250 CR for you to be able to get the whole benefit of liquidity on M1 exchange, the trades platform. Now, that is not, again, RBI has clarified that even if you changed from being an MSME to a non-MSME, which means you grew beyond 250 CR of turnover in last 3 years, you can still participate on M1. That's fine. But let's say if you became a non-MSME 3 years back, then yes, you can't do it on M1 as a seller. As a buyer, of course you can, but not as a seller. And the moment you are not an MSME, the banks don't get what is called a PSL, priority sector lending, which is where the moment you're a non-MSME, the rates tend to become slightly higher. So that's a difference why you'll find the rates to be slightly different, but otherwise M1, M2, you can get the same benefit across the board.
Thank you.
Maybe we can exchange outside the room
Yeah,
for
I
a
think we
discussion.
can continue discussions over tea in the break and during the later part of the evening. So thank you very much, ladies and gentlemen, and thank you, panelists. It was an exciting and good discussion. Thanks.
Thank you, Wilson. Thank you. Thank you.
Thank you, Mr. Putty. It has been a long discussion, but obviously money matters cannot be shortened. So, and that too, a session where working capital and payments are concerned. May I request Mr. Sanjay Behra, Chairperson of the Manufacturing MSME Committee of Bengal Chamber, and he's also the Chief Sales Manager of Tata Steel, to give some mementos. Mr. Wilson Mutti, please, as the chair of the session. Thank you. To Mr. Rishabh Agarwal. Mr. Vivek Chauhan. And Mr. Amit Sachdeva. I think the person to whom the maximum questions are going to be directed have already been. Thank you so much, Mr. Bera. As we wait for the fifth session to start, please do watch a short video about the support partners of this conclave.
Its vision to become a global player has contributed immensely to the successful manufacture of a wide range of automotive products, including critical welded assemblies like cross-car beam for passenger cars, tractor fenders, hood and grilled assemblies, and also welded assemblies like brake and clutch pedals, and wide range of fabricated components. Welding quality is critical aspect of all welded assemblies. Reliable strives to get latest welding solutions like CMT, cold metal transfer technology, which has distinguished advantages like excellent gap bridging ability, 50% less dilution of base and filler metal cutting cost, ultra-high precision in welding process, extremely low spatter, minimal distortion, extremely low thermal input, higher welding speeds boosting the productivity. Synchronized welding process is used for cross-car beam to ensure horizontal welding of all the specified area.